A cataclysmic commercial real estate collapse is happening in plain sight, and no one seems to be talking about it. We've just recorded the biggest month-over-month property value drop since the global financial crisis. The sector is facing an increasingly dire situation fueled by weakening demand, record storefront vacancies, a shift to remote working, and souring credit conditions. Experts say that the slump in the world's biggest asset class has spread from the housing market to commercial real estate, and now a flood of distressed loans can result in an 84% value destruction and unleash serious turmoil all across the U.S. economy. Commercial property, from offices to shopping malls, is more sensitive to economic conditions than other asset classes, as explains Andreas Dombre from the Bank for International Settlements, adding that when large financial bubbles burst, this is very often related to commercial real estate. A recent study by NYU scholars is using the word apocalyptic to describe the crisis that's now unfolding before our eyes. By analyzing data provided by research firm Green Street, commercial property prices have already dropped by 13% in 2023, the largest monthly decline since it began tracking this data in 2007 in the run-up to the global financial crisis. NYU professor Arpit Gupta and his team point to a looming commercial real estate apocalypse, with office prices declining 84% in less than 5 years. Since 2020, commercial property values have fallen by 45%, and according to their projections, another 39% collapse is going to take place by 2025. That represents a $453 billion value destruction. Many urban centers are in danger of falling into a fiscal doom loop, they said. Similar damage could hit other areas and, by extension, the national economy, the scholars wrote. Moody's Analytics documented that securities backed by commercial mortgages saw a huge spike in elevated delinquency rates in the past quarter. In 2020, the same has occurred, but back then, easy credit conditions led banks, life insurance investors, and others to restructure distressed loans and offer forbearance, lessening their delinquency rates. But now the tables have been turned. With the Fed raising rates and making borrowing more costly, the commercial real estate market is hanging by a very thin thread. Adding to the discouraging outlook, Green Street co-head of strategic research Peter Rotherman adds that 2023 will likely be marked by other sharp declines in commercial property prices. As large as the decline in pricing has been, I don't think we're out of the woods. As long as the 10-year Treasury note stays above 4%, prices will continue to collapse. What we have in this downturn is a fairly unique set of economic circumstances. Interest rates are tightening instead of softening the blow for real estate and other corporates, said Ian Guthrie, a senior managing director at the loan advisory team at Jones Lang LaSalle Inc., that's a real estate broker. The Federal Reserve has already hiked interest rates 7 times, and it's not finished yet, which means that the environment for borrowers and lenders is expected to deteriorate even further as the months go by. The repercussions are already being felt all across the country. In Los Angeles, a Brookfield real estate unit is warning it's struggling to refinance debt on 2 downtown Los Angeles towers and recently raised the prospect of foreclosures, which Barclays PLC analysts called disturbing for the entire market. In San Francisco, the San Francisco Standard is alerting about an epic commercial real estate crash, with several commercial buildings seeing prices crash by up to 72%, while prices in the residential market slumped by 35%, which is to say that the city's property bubble was officially the first to explode catastrophically. Even Tesla CEO Elon Musk and PayPal co-founder David Sacks have expressed their concern about this developing crisis. On Twitter, Sacks shared a chart showing that the price of office space in San Francisco is at the same level it was during the peak of the Great Recession in 2009. In reply to the tweet, Musk warned that prices would go even lower soon. The debt crunch has also been visible in downtown Chicago, with soaring construction costs, property taxes, interest rates, and a record amount of available office space, depressing property prices the most in nearly 2 decades. Meanwhile, in New York, remote work is killing Manhattan's commercial real estate market, Bloomberg highlights, with more buildings sitting empty than being occupied by businesses. At the same time, investors are looking to foreclose on one of the country's largest malls in the city, the Palisades Center Mall. The same is happening in New Jersey, where lenders to the American Dream Mall are heading to court, demanding a $389 million payment on their defaulted debt. In LA, the owners of a Westfield Mall expect it to be foreclosed if they can't sell the property. Nationwide, storefront vacancies stood at a 20-year high during much of 2022, as the absence of daily foot traffic compounded the effects of online shopping on brick-and-mortar retailing. Billionaire investor Carl Icahn says that the collapse of the U.S. mall industry is near. The industry has been shaky for years, of course, but now that interest rates are soaring from record low levels, lenders are beginning to move aggressively against property owners, he notes. Today, we still have many borrowers now demanding bigger discounts than many lenders are prepared to offer. The leveraged buyer has been pretty much handcuffed and removed from the bidding tent because of what's happened with interest rates and debt financing, said Knott at Green Street, referencing the broader market. Lenders have not fully reset their expectations to better align with where buyers are, so we do see a large bid-ask spread. But this standoff over valuations has contributed to banks and other credit providers being even more conservative around new lending. When landlords come to refinance, they may have to inject as much as 25% of the original purchase price to satisfy the metrics that banks lend against, according to Green Street's Rotherman. This pressure on the ratios that measure borrowers' ability to cover interest payments is a dynamic which has not been felt since the days of the financial crisis, he continued. Simultaneously, weak demand and a surge of sublease offerings from companies trying to shed unneeded workspace are forcing landlords to shell out huge amounts of cash and other perks to get deals done, while pushing some to surrender their properties to their lenders rather than face foreclosed battles. Right now, one of the biggest risks in commercial real estate is older and less desirable office and retail space. New reports indicate that private equity investors are walking away from the sector due to rising uncertainty about the future of commercial properties amid raging inflation and construction and financing costs during the recession. Consider the apocalypse analysts from NYU professors. The research combined working from home data with financial information from real estate investment trusts, plus other financial information, and predicted long-run office valuations will continue to plummet at a double-digit rate due to lower quality office stock, a more substantially stranded asset. Now we have a pipeline of potentially defaulting loans where values are under pressure and cash flows are under pressure, they wrote. Almost $175 billion of real estate credit is already distressed, according to data compiled by Bloomberg, about 4 times more than in the residential sector. In Rotherman's view, 2023 is when all of those problems will start to manifest themselves. At the moment, about 1 in 10 corporate loans in the U.S. is already underperforming and showing increased credit risk, Bank of America reported. And major banking institutions are already preparing for growing credit losses this year. In its fourth quarter results, Bank of America flagged an additional $1 billion of office property loans with an elevated risk of default or missed payments, while Wells Fargo & Co. expects more stress to emerge in that market as demand cools off and the economic downturn intensifies. The turnaround has been so swift that some private credit lenders are already struggling with liquidity, reveals Tom Kapas, Chief Executive Officer at real estate financing firm Ready Capital Corporation. We're already in a bear market where banks are pruning their portfolios, he highlights. The office sector in the U.S. is uninvestable. No one wants to finance it. There's a belief that liabilities are bigger than potential gains, Kapas said. Even newer offices could be endangered as job cuts in the tech sector reduce demand. This trend still has a couple of years to run, maybe even 5 or 6 years to run, before we reach an equilibrium, he predicts. When loans on older offices come due to refinancing, you will see such a drop in values that unless a borrower can put in a significant amount of equity, they will have to pass the keys back. Then the lender will bring that to the market at a distress level, stresses Jack Creedon, co-head of the real estate practice at law firm Ropes & Gray. we could see 20 to 30% of the existing office market wiped in the US. They will never get leased again. The Urban Land Institute is forecasting a 50% decline in real estate profits this year as a result of the crisis in commercial properties. A flood of defaults and the fall in transactions and development in the market will inevitably impact spending in the real economy. In turn, that could pose a risk to jobs and growth. Several construction companies have started to lay off thousands of workers. Last week, the latest to enter the list was U.S. home building supplier Builders FirstSource, which cut 10% of its workforce. The signs of a deep recession are mounting in America. Adam Tu is a professor at New York's Columbia University who's written about the 2008 crash, sees reasons to worry again. Property is a major recession variable, he said. It's the biggest asset class and is directly linked to household budgets, which means it carries consequences for consumption. The combined meltdown of both commercial and residential real estate is unprecedented in all of U.S. history. The amount of wealth that can be wiped out from the system can reach the trillions before this is all over. We are in for a very rough ride, and we have very limited alternatives. Even if older buildings could be converted into housing, that's not an easy or immediate process. It's not cheap either. Collapsing real estate values can also trigger disastrous fiscal problems for many cities, resulting in cuts to social services, education, public health, and other essential government functions. This situation can also contribute to the long list of social issues that we have, and exacerbate income and wealth disparities at a moment when inequality is already at its worst. The resilience of U.S. businesses and consumers is at stake, and while thousands upon thousands of companies can disappear in that process, Americans can lose everything they have ever fought for. This is not just a housing and commercial real estate collapse. This is a reflection of a broken economy and a decaying society. While the sector's apocalypse looms over us, now more than ever, we need to keep one eye on the danger.